Okay, let's dive right into this explainer and figure out exactly how you track your cash when you're relying on an agent to sell your goods. I mean, it's one of those foundational yet super misunderstood processes in business, right? You've got great products, you want to expand your reach, so you partner up with an agent in another territory. But once those goods actually leave your warehouse, how do you mathematically and, more importantly, practically keep track of the finances? Well, today we are completely demystifying the document that answers that exact question.
Think about it. If you are the consignor, the boss, the principal, handing over inventory, but you literally have zero clue about the day-to-day sales status on the ground, well, this is the stressful question keeping you up at night. You know the goods arrived safely, sure, but where exactly is your money? Without a standardized way to actually report and settle up these transactions, you are pretty much flying blind.
So here is our agenda for today's explainer. First, we'll look at the consignment relationship. Second, we'll dive into the 4 calculation steps. Third, why consignors need it. And finally, number 4, the bottom line. All right, section 1, the consignment relationship.
So the ultimate fix for that blind spot we just talked about, it's a document called the account sale. Basically, it's a periodic statement that the consignee, which is your agent, submits to you, the principal. It gives you the full rundown of every single transaction related to your consigned goods. This thing is absolutely crucial because it tells you the actual sale proceeds realized, details all those little expenses the agent incurred, shows the commission they're owed, and finally, gives you the exact balance payable to you.
Moving right along to section 2, the 4 calculation steps. When it comes to the practical preparation process of an account sale, it follows a really logical sequence to figure out what you're actually owed. Here are the 4 essential calculation steps. First, record the gross sales. Second, deduct expenses. Third, deduct the commission. And fourth, adjust for any advances. It's kind of like peeling an onion, layer by layer, and we're going to look at each of these essential steps right now.
Step 1 is all about capturing that total revenue. You start with the big number. The agent has to clearly outline the quantity and the exact description of the goods that sold, along with the total gross sale proceeds realized. This is your absolute top-line figure before anybody takes a cut or pays a single fee. It tells you exactly what the market was willing to pay for your inventory.
Now for step 2. This is where we start peeling away from that gross number by deducting legitimate expenses incurred by the consignee. Look, the agent had to spend money to sell your goods, right? So from those gross proceeds, they'll subtract their operational costs. We're talking about things like freight to move the goods, octroi, which is basically just a local municipal tax, go down or warehouse rent, and other direct selling expenses. These are just the normal operational realities of doing business away from your home base. On to the third layer, step 3. Here, we've got to subtract the commission due to the consignee. And this is calculated strictly based on your agreed-upon rate. Because, the agent isn't out there working for free. They always get their cut before they send that final check back to the principal, which is actually great because it perfectly aligns their incentives with yours. Bigger gross sales in step 1 means a bigger commission for them in step 3. Next up, we make our final adjustment. In step 4, we deduct any advance remittances the agent already sent you as security. It's super common in consignment for the agent to send a bank draft or a bill of exchange up front just to secure the inventory. Well, since you already got that money in your pocket earlier, we have to subtract it from the remaining subtotal now. Obviously, we don't want the agent double paying you. So the really crucial point here is that once you peel away all those layers, the expenses, the commissions, the advances, you are left with the resulting figure. The net balance due to you, the consignor. This is the actual real cash value you have earned for this period. Usually, the consignee will remit this exact net balance right along with the account sales statement itself, often using a bank draft or a bill acceptance.
Okay, section 3, why consignors need it.
Since you don't have direct oversight of the agent's day-to-day operations, the account sale perfectly bridges that gap. It completely swaps out that scary blind spot for concrete account sale intelligence. You get full, uncompromised details on exactly how many units sold and the precise market price they sold for. It lets you gauge the true sales performance without having to literally fly out there and check on it yourself. Plus, it acts as the absolute vital source document for your own accounting. You literally use this one single statement to officially record the sales, the expenses, and the commissions in your own books. It gives you complete financial settlement transparency. By posting all these details straight into your consignment account, you can confidently ascertain your final net profit or loss for that specific batch of goods.
Without this document, you literally cannot close your books. And that brings us to Section 4, the bottom line.
I'm going to leave you with this provocative thought. What actually happens to your profit margins if step 2, those operating expenses, or step 3, the agent's commission, gets completely out of hand? If you aren't carefully tracking these 4 steps through regular account sales, how can you possibly evaluate the true value of your agent partnerships? Definitely something to think about the next time you ship your inventory out into the world. Thanks so much for joining me for this explainer. And hey, keep a really close eye on those 4 calculation steps